Question 1. The review process indicates that a Delaware real estate licensee is tasked with valuing a historic property that has unique architectural features and has been used for specialized events. The licensee is considering different valuation methods. Which method would best align with Delaware's regulatory framework for providing an accurate and ethically sound valuation in this scenario? Option A. Income approach, estimating value based on the potential rental income from specialized event bookings. Option B. Comparative market analysis, focusing on recent sales of similar historic or uniquely featured properties with appropriate adjustments. Option C. Cost approach, calculating the cost to rebuild the property minus depreciation. Option D. A hybrid approach combining elements of the income and cost approaches without a primary market-based component. The correct answer is B. Comparative market analysis, focusing on recent sales of similar historic or uniquely featured properties with appropriate adjustments. Explanation. The review process indicates a common challenge faced by real estate licensees in Delaware, determining the most appropriate valuation method for a unique property. This scenario is professionally challenging because the property's characteristics, its historical significance and specialized use, do not lend themselves easily to standard valuation techniques. A licensee must exercise careful judgment to select a method that accurately reflects the property's market value while adhering to Delaware's real estate licensing laws and ethical standards. The most appropriate approach in this scenario is the comparative market analysis, CMA. A CMA involves analyzing recent sales of similar properties in the same geographic area, adjusting for differences in features, condition, and location. For a historically significant property, the licensee would need to identify comparable sales of other historic properties, if available, or properties with similar unique features that have recently sold. Adjustments would be crucial to account for the historical designation's impact on value, which can be positive due to desirability or negative due to restrictions on alterations. Delaware's real estate regulations, particularly those concerning fair dealing and accurate representation, mandate that licensees provide clients with information that is not misleading. A CMA, when properly executed with thorough research and appropriate adjustments, best fulfills this obligation by grounding the valuation in observable market data, even for unique properties. It aligns with the ethical duty to represent the client's interests diligently and competently. Using the income approach, which estimates value based on the potential income a property can generate, would be problematic. While some historic properties might have income-generating potential e.g., as a bed and breakfast or event venue, the specialized nature of this property and the potential for fluctuating income streams make this method less reliable for establishing a baseline market value without significant assumptions. This could lead to an inaccurate valuation and potentially mislead the client, violating the duty of competence. The cost approach, which estimates the cost to replace or reproduce the property, minus depreciation, is also unsuitable. This method is generally best for newer construction or special-purpose properties, where comparable sales are scarce and income potential is not the primary driver of value. For a historic property, accurately estimating the cost of reproduction or replacement, especially considering unique architectural elements and materials, is exceedingly difficult and prone to significant error. Furthermore, it fails to capture the market's perception of value for such a unique asset, potentially leading to an unrealistic valuation and a breach of the duty to provide accurate market information. Professionals should approach property valuation by first understanding the property's characteristics and the purpose of the valuation. They should then consider the most relevant valuation methods, prioritizing those that rely on observable market data and are best suited to the property type. A thorough understanding of Delaware's real estate laws, including those related to disclosure and fair dealing, is essential. When faced with unique properties, licensees must be prepared to conduct extensive research, make well-supported adjustments, and clearly communicate the limitations of any chosen valuation method to their client. Question 2. Performance analysis shows that a Delaware real estate salesperson is representing a buyer interested in a residential property in Wilmington. The buyer expresses concern about the potential for future commercial development in the adjacent area and how it might impact the property's quiet enjoyment and value. What is the most appropriate course of action for the salesperson to take regarding zoning laws and land use regulations? Option A. Assume that since the property is currently zoned for residential use, There are no immediate concerns regarding future development and advise the buyer not to worry. Option B. Tell the buyer that zoning is their responsibility to investigate and that the salesperson cannot provide any information or assistance on the matter. Option C. Offer a personal opinion on the likelihood of future commercial development based on general knowledge of the area and assure the buyer that the property will likely remain unaffected. Option D. Proactively research Wilmington's current zoning ordinances and any known land use plans or restrictions that could affect the property. Then clearly communicate these findings to the buyer and advise them to consult with the City of Wilmington's Planning Department or legal counsel for definitive interpretations. The correct answer is D. Proactively research Wilmington's current zoning ordinances and any known land use plans or restrictions that could affect the property. Then clearly communicate these findings to the buyer and advise them to consult with the City of Wilmington's Planning Department or legal counsel for definitive interpretations. Explanation. Scenario analysis. This scenario presents a professional challenge for a Delaware real estate salesperson because it requires navigating the complexities of local zoning ordinances and land use regulations, which can significantly impact property value and development potential. Misinterpreting or failing to disclose these regulations can lead to significant legal and ethical repercussions for the salesperson and their client, including potential lawsuits, loss of commission, and damage to reputation. The salesperson must balance their duty to their client with their obligation to adhere to legal requirements and ethical standards. Correct approach analysis. The best professional approach involves proactively researching and understanding the specific zoning and land use regulations applicable to the subject property in Wilmington, Delaware. This includes identifying the current zoning classification, any overlay districts, and any known or potential future land use restrictions or planned developments that could affect the property. The salesperson should then clearly and accurately communicate these findings to the prospective buyer, advising them to consult with the appropriate municipal authorities or legal counsel for definitive interpretations and guidance. This approach is correct because it aligns with the salesperson's fiduciary duty to act in the best interest of their client by providing material information and exercising due diligence, while also adhering to Delaware's real estate licensing laws and ethical codes that mandate honesty, disclosure, and competence. Incorrect approaches analysis. One incorrect approach is to assume that because the property is currently used as a single-family residence, no further investigation into zoning is necessary. This fails to acknowledge that zoning laws can change, or that there may be existing restrictions on future use or development that are not immediately apparent. This approach violates the duty of diligence and could lead to a buyer making an uninformed purchase based on incorrect assumptions about the property's potential. Another incorrect approach is to dismiss the buyer's concerns about zoning as a matter for the buyer to resolve independently without providing any relevant information. While buyers are ultimately responsible for their due diligence, a salesperson has a professional obligation to disclose known material facts and assist in facilitating access to information. This approach demonstrates a lack of competence and a failure to uphold ethical standards, potentially leaving the buyer vulnerable and the salesperson liable. A third incorrect approach is to provide a personal interpretation of the zoning laws or to offer assurances about future zoning changes without proper authority or expertise. This constitutes practicing law without a license and can lead to significant misrepresentation. Zoning regulations are complex and require expert interpretation, and making definitive statements without such expertise is both unethical and illegal. Professional reasoning. Professionals should adopt a framework that prioritizes thorough research, transparent communication, and expert consultation. When dealing with zoning and land use, the process should involve 1. Identifying the specific municipality and relevant governing bodies. 2. Accessing official zoning maps and ordinances. 3. Consulting with municipal planning departments for clarification. 4. Clearly documenting all findings and disclosures to the client. 5. Recommending that the client seek independent legal or professional advice for complex matters. This systematic approach ensures compliance, protects all parties, and upholds the integrity of the real estate profession. Question 3. Governance review demonstrates that a Delaware real estate salesperson has facilitated the signing of a purchase agreement for a property. Upon reviewing the executed documents, the salesperson notices that the buyer and seller have both signed the agreement, but the buyer has not included an earnest money deposit as stipulated in the contract. What is the most appropriate course of action for the salesperson to advise their client? Option A. Advise the client that the absence of an earnest money deposit does not automatically render the contract unenforceable, but recommend consulting with a Delaware real estate attorney to clarify the contract's enforceability and address any ambiguities. Option B. Suggest that the salesperson can unilaterally add the earnest money deposit to the contract after signing to rectify the omission. Option C. Inform the client that the contract is automatically void and unenforceable because the earnest money deposit was not provided as required. Option D. Advise the client to proceed with the transaction based on verbal assurances from the buyer and seller, as a written agreement is not strictly necessary for enforceability in this instance. The correct answer is A. Advise the client that the absence of an earnest money deposit does not automatically render the contract unenforceable, but recommend consulting with a Delaware real estate attorney to clarify the contract's enforceability and address any ambiguities. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a real estate salesperson in Delaware to navigate the enforceability of a contract when a critical element, the earnest money deposit, is missing. The salesperson must understand the legal implications of such an omission and advise their client appropriately, balancing the client's desires with the legal requirements for a valid contract. Failure to do so could lead to disputes, financial losses, and damage to the salesperson's reputation and license. Correct approach analysis. The best professional practice involves advising the client that the absence of an earnest money deposit, while common and often expected, does not automatically render the contract unenforceable in Delaware. The salesperson should explain that enforceability hinges on the presence of all essential contract elements: offer, acceptance, consideration, legal purpose, and competent parties. While earnest money serves as a form of consideration and demonstrates good faith, its absence can be addressed through other forms of consideration or by the parties' mutual agreement to proceed without it. The salesperson should recommend consulting with a Delaware real estate attorney to ensure the contract's terms are clearly understood and to address any potential ambiguities regarding consideration or enforceability. This approach prioritizes legal accuracy, client education, and professional diligence by recommending expert legal counsel for definitive advice. Incorrect approach is analysis. Advising the client that the contract is automatically void and unenforceable due to the missing earnest money deposit is incorrect. While earnest money is a customary part of real estate transactions in Delaware and often serves as a form of consideration, its absence does not automatically invalidate a contract if other essential elements are present and the parties intend to be bound. Contract may still be enforceable if other valid consideration exists or if the parties waive the requirement. Suggesting that the salesperson can simply add the earnest money deposit to the contract after it has been signed by both parties without their explicit agreement is also incorrect. This action would constitute a material alteration of the contract and would require the mutual consent of both the buyer and seller to be legally binding. Proceeding without such consent could render the contract voidable or unenforceable. Recommending that the client proceed with the transaction without any written agreement, relying solely on verbal assurances, is fundamentally flawed and highly risky. Real estate contracts in Delaware must be in writing to be enforceable under the statute of frauds. Verbal agreements for the sale of real property are generally not legally binding and would expose both parties to significant risk and potential disputes. Professional reasoning. Professionals in Delaware should always prioritize understanding the essential elements of a valid real estate contract as defined by Delaware law. When faced with a missing customary element like earnest money, the professional's duty is to educate the client on the legal implications, not to make definitive legal pronouncements. The correct decision-making process involves 1. Identifying the core legal requirements for contract enforceability in Delaware. 2. Assessing the impact of the missing element on those requirements. 3. Clearly communicating the legal nuances to the client. 4. Recommending consultation with qualified legal counsel for definitive advice and to ensure the contract accurately reflects the parties' intentions and is legally sound. This layered approach protects the client, upholds professional standards, and mitigates liability. Question 4. Investigation of a potential client's interest in real estate investments in Delaware leads a licensed salesperson to discuss various investment vehicles. The client expresses a desire for passive income and diversification. The salesperson considers explaining real estate investment trusts, rate. Which of the following approaches best educates the client about rate while adhering to Delaware's real estate licensing requirements and ethical standards? Option A. Describe a rate as simply a way to own a piece of buildings without mentioning its stock market trading or potential for value changes. Option B. Explain that a rate is a company that owns, operates, or finances income-producing real estate, is traded on major stock exchanges, and its value is subject to market fluctuations, similar to stocks, while also highlighting its potential for income distribution. Option C. Present a rate as a type of mutual fund that invests in properties, focusing solely on its diversification benefits. Option D. Market a rate as a guaranteed source of passive income with no risk of capital loss, emphasizing its real estate backing. The correct answer is B. Explain that a rate is a company that owns, operates, or finances income-producing real estate, is traded on major stock exchanges, and its value is subject to market fluctuations, similar to stocks, while also highlighting its potential for income distribution. Explanation. This scenario presents a professional challenge because a real estate salesperson in Delaware must accurately represent investment opportunities, especially those involving real estate investment trusts, rate, to clients. Misrepresenting the nature or risks of a rate can lead to significant financial harm for the investor and regulatory repercussions for the salesperson. Careful judgment is required to ensure compliance with Delaware's real estate licensing laws and ethical obligations. The best approach involves clearly distinguishing between a direct real estate investment and an investment in a rate. This means explaining that a rate is a security that pools investor capital to purchase or finance income-producing real estate. It is crucial to highlight that rates are traded on major exchanges, similar to stocks, and their value fluctuates based on market conditions and the performance of the underlying real estate assets. This approach is correct because it aligns with the Delaware Real Estate Commission's mandate to ensure licensees provide accurate and complete information to the public. By differentiating rate from direct property ownership, the salesperson avoids misleading the client about the nature of the investment, its liquidity, and the associated risks, which are inherent in securities trading. This also respects the distinction between real estate brokerage activities and security sales, which may require separate licensing or disclosures depending on the specific transaction and the salesperson's affiliations. An incorrect approach would be to describe a rate as simply owning buildings without further clarification. This is problematic because it oversimplifies the investment and fails to convey the critical distinction that the client is purchasing shares in a company that owns real estate, not a direct stake in a specific property. This omission can lead the client to believe they have direct control or ownership rights similar to traditional real estate, which is not the case. This misrepresentation violates the duty of honesty and fair dealing owed to clients under Delaware law. Another incorrect approach is to equate a rate with a mutual fund that invests in real estate. While both are pooled investment vehicles, the underlying assets and regulatory frameworks differ significantly. Rates are specifically focused on real estate, and their tax structure is unique. Equating them broadly can obscure the specific risks and characteristics of rate, potentially misleading the investor about the investment's nature and risk profile. This lack of specificity can be construed as a failure to provide adequate information, potentially violating Delaware's regulations regarding disclosure and fair representation. Finally, an incorrect approach would be to present a rate as a guaranteed income-generating investment, without mentioning market volatility. While rates often aim to distribute income, their share prices are subject to market fluctuations, and dividends are not guaranteed. Presenting them as a risk-free income stream is a misleading oversimplification that fails to disclose material risks, directly contravening ethical obligations and potentially violating Delaware's consumer protection laws related to investment solicitations. Professionals should adopt a decision-making framework that prioritizes transparency and accuracy. This involves thoroughly understanding the investment products they are presenting, identifying potential client misunderstandings, and proactively providing clear, concise, and comprehensive information. When discussing rate, professionals should always clarify their nature as securities, their trading mechanisms, and the associated risks and rewards, ensuring that clients can make informed decisions based on accurate representations. Question 5. Comparative studies suggest that real estate professionals must possess a nuanced understanding of property law to effectively guide clients. In Delaware, a prospective buyer is seeking to understand the fundamental differences between various ways property can be owned. Which of the following explanations most accurately and comprehensively distinguishes between fee simple ownership, leasehold estates, joint tenancy, and tenancy in common, highlighting the critical legal distinctions relevant to a buyer's long-term interests? Option A. Fee simple ownership is the right to use a property for an extended period, similar to a long-term lease, while leasehold estates are for shorter durations. Joint tenancy and tenancy in common both mean multiple people own the property, with no significant legal differences for inheritance. Option B. Fee simple ownership is the right to possess and use a property indefinitely, but not to sell it. Leasehold estates are for a fixed period. Joint tenancy means all owners have equal rights, and tenancy in common means owners can have unequal shares. Option C. Fee simple ownership is the most complete form of ownership, granting indefinite rights to possess, use, and dispose of the property, distinct from a leasehold estate, which is a temporary right to possess property for a set term. Joint tenancy and tenancy in common are both forms of concurrent ownership, where multiple parties hold an interest in the same property, with the primary distinction being the presence of a right of survivorship in joint tenancy. Option D. Fee simple ownership is the most complete form of ownership, granting indefinite rights to possess, use, and dispose of the property, distinct from a leasehold estate, which is a temporary right to possess property for a set term. Joint tenancy includes the right of survivorship, meaning a deceased owner's share passes to surviving joint tenants, whereas tenancy in common allows a deceased owner's share to pass according to their will or intestacy laws. The correct answer is D. Fee simple ownership is the most complete form of ownership, granting indefinite rights to possess, use, and dispose of the property, distinct from a leasehold estate, which is a temporary right to possess property for a set term. Joint tenancy includes the right of survivorship, meaning a deceased owner's share passes to surviving joint tenants, whereas tenancy in common allows a deceased owner's share to pass according to their will or intestacy laws. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a real estate salesperson in Delaware to accurately advise a client on the implications of different property ownership structures, specifically distinguishing between fee simple and leasehold estates, and understanding the nuances of concurrent ownership like joint tenancy and tenancy in common. Misunderstanding or misrepresenting these concepts can lead to significant legal and financial consequences for the client, potentially resulting in disputes, loss of property rights, or unintended inheritance outcomes. The salesperson must demonstrate a thorough grasp of Delaware property law and ethical obligations to provide competent and trustworthy advice. Correct approach analysis. The best professional approach involves clearly explaining to the client that fee simple ownership represents the most complete form of ownership, granting the owner the right to possess, use, and dispose of the property indefinitely, subject only to governmental powers like eminent domain and taxation, and private restrictions like covenants. This approach is correct because it accurately defines the fundamental nature of fee simple ownership as understood under Delaware law, emphasizing its permanence and breadth of rights. It also involves differentiating this from a leasehold estate, which grants the right to use and possess property for a specific period under a lease agreement, with ownership remaining with the landlord. Furthermore, it requires explaining that joint tenancy and tenancy in common are forms of concurrent ownership, where multiple parties hold an interest in the same property. Highlighting the key difference, joint tenancy includes the right of survivorship, where the deceased owner's share automatically passes to the surviving joint tenants, while tenancy in common does not, where the deceased owner's share passes according to their will or intestacy laws. This comprehensive and accurate explanation aligns with the salesperson's duty of care and competence under Delaware real estate licensing regulations, ensuring the client makes informed decisions based on a correct understanding of their potential property rights. Incorrect approach is analysis. An approach that focuses solely on the duration of possession without clarifying the underlying ownership rights is professionally unacceptable. This fails to distinguish between the right to possess property, as in a leasehold, and the right to own it outright, as in fee simple, leading to confusion about the client's true legal standing and the permanence of their interest. This violates the duty to provide accurate information and can mislead clients about the extent of their property rights. Another professionally unacceptable approach is to conflate joint tenancy and tenancy in common by emphasizing only that multiple people own the property, without explaining the critical difference in the right of survivorship. This omission can lead to unintended inheritance outcomes, as the client may believe their share will pass to their chosen heirs when, in fact, it would pass to the surviving co-owners under a joint tenancy. This demonstrates a lack of understanding of fundamental property law principles and a failure to provide complete and accurate advice, potentially breaching ethical obligations and statutory requirements for licensees. A third professionally unacceptable approach is to describe fee simple ownership as merely the right to use a property for an extended period, similar to a long-term lease. This fundamentally misrepresents the nature of fee simple ownership, which is an absolute and perpetual interest, not merely a right of use for a duration. This mischaracterization can lead clients to underestimate the value and permanence of their ownership rights, potentially impacting their financial decisions and their understanding of their property's marketability. Professional reasoning. Professionals should approach client inquiries about property ownership by first identifying the core legal concepts involved. They must then consult relevant Delaware statutes and common law principles to ensure their understanding is accurate and up-to-date. When advising clients, professionals should prioritize clarity, accuracy, and completeness, using plain language to explain complex legal terms. Structured approach, starting with the most comprehensive form of ownership, fee simple, and then detailing variations and concurrent ownership types, helps build a solid understanding for the client. Professionals should always be prepared to answer follow-up questions and ensure the client comprehends the implications of each ownership type for their specific situation, thereby fulfilling their fiduciary duties and adhering to professional standards. Question 6. The investigation demonstrates that a prospective buyer, when discussing their housing preferences for a property in Wilmington, Delaware, explicitly stated they are only interested in neighborhoods with a specific ethnic demographic and asked the salesperson to only show them homes in those areas. What is the most appropriate and legally compliant course of action for the real estate salesperson? Option A. Immediately terminate the relationship with the buyer and refuse to show them any properties, without providing any explanation for the refusal. Option B. Advise the buyer that while you cannot guarantee specific demographics, you will do your best to find properties in areas that generally fit their description. Option C. Agree to the buyer's request, but subtly try to steer them towards properties that might align with their stated demographic preference, without explicitly mentioning the discriminatory aspect. Option D. Politely inform the buyer that you cannot fulfill their request because it violates fair housing laws, and briefly explain that all housing opportunities must be presented without regard to race, color, religion, sex, familial status, national origin, or ancestry. The correct answer is D. Politely inform the buyer that you cannot fulfill their request because it violates fair housing laws, and briefly explain that all housing opportunities must be presented without regard to race, color, religion, sex, familial status, national origin, or ancestry. Explanation. This scenario presents a professional challenge because it requires a real estate salesperson to navigate a delicate situation involving a potential client's discriminatory request while upholding their ethical and legal obligations under Delaware's Fair Housing Act. The salesperson must balance the desire to secure a client with the absolute mandate to prevent discrimination in housing transactions. The risk lies in inadvertently facilitating or appearing to condone discriminatory practices, which carries severe penalties. The best professional approach involves politely but firmly refusing to engage with the discriminatory request and educating the client on fair housing laws. This approach directly addresses the discriminatory intent without being accusatory, clearly states the salesperson's inability to comply with the illegal request, and provides a brief, factual explanation of the relevant legal framework. This aligns with the salesperson's duty to act ethically and legally, ensuring that all housing opportunities are presented without regard to protected characteristics. This is the most effective way to mitigate legal risk and maintain professional integrity. An incorrect approach would be to agree to the client's request, even with reservations, or to attempt to subtly steer the client towards properties that might align with their discriminatory preference without explicitly stating it. Agreeing to the request directly violates Delaware's Fair Housing Act and opens the salesperson and their brokerage to significant legal penalties, including fines and license revocation. Attempting to subtly comply is equally problematic as it still facilitates discrimination and demonstrates a lack of understanding or willingness to adhere to fair housing principles. Another incorrect approach would be to dismiss the client outright without any explanation or attempt at education. While this avoids direct participation in discrimination, it misses an opportunity to educate a potential client about fair housing laws and could be perceived as unprofessional or unhelpful. More importantly, it doesn't proactively address the underlying discriminatory sentiment, which is a key aspect of promoting fair housing. A professional decision-making process in such situation should begin with identifying the discriminatory nature of the request. The salesperson must then immediately recall their obligations under the Delaware Fair Housing Act. The next step is to formulate a response that is both legally compliant and ethically sound, prioritizing the refusal of the discriminatory request and providing a brief, educational explanation of fair housing principles. This process ensures that the salesperson acts with integrity and avoids any actions that could be construed as discriminatory. Question 7. A seller in Delaware wishes to offer seller financing to a prospective buyer for their property. The seller has provided a basic outline of the desired terms for a promissory note and mortgage. As a licensed Delaware real estate salesperson, what is the most appropriate course of action to ensure a legally sound and ethically compliant transaction? Option A. Draft the promissory note and mortgage documents for the parties using a template found on a real estate industry website, ensuring the terms generally align with the seller's outline. Option B. Advise both the seller and the buyer to consult with their respective attorneys to draft and review the promissory note and mortgage documents, and encourage the buyer to obtain independent mortgage pre-approval from a licensed lender. Option C. Verbally assure the buyer that the seller's proposed financing terms are reasonable and standard within the Delaware market based on your general experience. Option D. Encourage the buyer to proceed with the seller financing without a formal mortgage pre-approval, suggesting that the seller's acceptance of the offer is sufficient financial vetting. The correct answer is B. Advise both the seller and the buyer to consult with their respective attorneys to draft and review the promissory note and mortgage documents, and encourage the buyer to obtain independent mortgage pre-approval from a licensed lender. Explanation. Scenario analysis. This scenario presents a professional challenge for a Delaware real estate salesperson because it involves navigating the complexities of seller financing while ensuring compliance with Delaware's real estate licensing laws and ethical obligations. The salesperson must balance the seller's desire for a quick sale with the buyer's need for clear and legally sound financing terms, all while acting in the best interests of both parties and avoiding potential conflicts of interest or misrepresentations. The salesperson's role is to facilitate the transaction, not to provide legal or financial advice beyond their licensing scope. Correct approach analysis. The best professional approach involves the salesperson acting as a facilitator and requiring the involvement of qualified legal and financial professionals. This means advising the seller and buyer to consult with their respective attorneys to draft and review the promissory note and mortgage documents. The salesperson should also encourage the buyer to seek independent mortgage pre-approval from a licensed lender to ensure the financing is viable and meets market standards. This approach is correct because it adheres to the Delaware Real Estate License Act, which prohibits licensees from engaging in the unauthorized practice of law or providing financial advice outside their expertise. It upholds ethical duties by ensuring parties receive competent legal and financial counsel, thereby protecting them from potential harm and ensuring the transaction is legally sound and transparent. Incorrect approaches analysis. One incorrect approach involves the salesperson drafting the promissory note and mortgage documents based on a template they found online. This is professionally unacceptable because it constitutes the unauthorized practice of law, a violation of Delaware statutes. The salesperson lacks the legal training and licensure to draft such critical legal instruments, and using a generic template without legal review significantly increases the risk of errors, omissions, and noncompliance with Delaware property law, potentially leading to legal disputes and financial losses for both parties. Another incorrect approach is for the salesperson to verbally assure the buyer that the seller's financing terms are fair and standard without any independent verification or professional consultation. This is ethically problematic and potentially violates Delaware's regulations against misrepresentation. The salesperson is not qualified to make such judgments and is acting outside their scope of expertise. Such assurances can mislead the buyer into believing the financing is more secure or favorable than it might actually be, creating liability for the salesperson and their brokerage. A third incorrect approach is for the salesperson to encourage the buyer to bypass a formal mortgage pre-approval process and rely solely on the seller's willingness to finance, suggesting that a formal lender review is unnecessary. This is a failure to act in the best interest of the buyer and can lead to a transaction that is not financially viable for the buyer. It also exposes the seller to the risk of default if the buyer cannot truly afford the payments. This approach neglects due diligence and can result in a failed transaction or significant financial distress for the buyer, reflecting poorly on the salesperson's professionalism and adherence to ethical standards. Professional reasoning. Professionals in this situation should employ a decision-making framework that prioritizes legal compliance, ethical conduct, and client protection. This involves recognizing the boundaries of their license and expertise. When complex financing is involved, the primary step is to identify the need for specialized professional input. The salesperson should clearly communicate to both parties the limitations of their role and strongly recommend seeking independent legal counsel for contract drafting and review, and financial advice or lender pre-approval for the buyer. Documentation of these recommendations is crucial. The salesperson's role is to facilitate communication and ensure all parties understand the process and the need for professional guidance, rather than attempting to provide that guidance themselves. Question 8. Market research demonstrates that a potential buyer in Wilmington, Delaware, has contacted you, a licensed real estate salesperson, stating they saw specific details about a property they are interested in on a social media platform that is not an official listing service. They are asking you to immediately provide them with the full property disclosure and a comparative market analysis based on this information. What is the most appropriate and legally compliant course of action? Option A. Explain that you can provide a comprehensive overview of the property and the buying process through official channels, including a comparative market analysis, but that you need to verify the information they have and ensure all disclosures are handled according to Delaware Real Estate Commission guidelines. Option B. Immediately provide the full property disclosure and a comparative market analysis based on the details they have, as they are clearly interested and you want to secure the business. Option C. Inform them that you cannot assist them because the information they have is not from an official source and you do not want to be involved in any potential misrepresentation. Option D. Agree to meet them at the property to discuss the details they saw on social media, bypassing your broker's office for this initial conversation. The correct answer is A. Explain that you can provide a comprehensive overview of the property and the buying process through official channels, including a comparative market analysis, but that you need to verify the information they have and ensure all disclosures are handled according to Delaware Real Estate Commission guidelines. Explanation. Scenario analysis. This scenario presents a common challenge for real estate professionals in Delaware, navigating the ethical and legal boundaries when a potential client expresses interest based on information obtained through potentially unauthorized channels. The challenge lies in balancing the desire to secure a client with the imperative to uphold professional standards and Delaware's real estate licensing laws. Missteps can lead to disciplinary action, reputational damage, and legal liabilities. Correct approach analysis. The best professional practice involves directly and transparently addressing the source of the information and clarifying the proper channels for engaging with a licensed professional. This approach prioritizes honesty and adherence to Delaware's real estate regulations, which mandate that all real estate activities be conducted by licensed individuals or entities. By offering to provide a comprehensive overview of the property and the buying process through legitimate means, the agent respects the client's interest while ensuring all interactions are compliant and ethical. This aligns with the Delaware Real Estate Commission's emphasis on professional conduct and consumer protection. Incorrect approaches analysis. One incorrect approach involves immediately offering to provide the specific details the potential client is seeking, even if that information was obtained through a source that may not be compliant with Delaware's real estate advertising and disclosure laws. This bypasses the established protocols for information dissemination and could involve sharing proprietary or unverified data, violating ethical duties and potentially Delaware regulations regarding fair dealing and accurate representation. Another incorrect approach is to dismiss the inquiry outright without attempting to understand the client's needs or offer legitimate assistance. While it's crucial to maintain professional boundaries, a complete refusal to engage, even to explain the proper process, can be seen as poor customer service and may not directly address the underlying regulatory concerns. It misses an opportunity to educate the consumer about compliant real estate practices. A further incorrect approach is to agree to meet the potential client outside of a licensed brokerage setting to discuss the property. This action could be construed as engaging in unlicensed activity or facilitating such activity, which is a direct violation of Delaware's real estate licensing laws and carries significant penalties. Licensed professionals are required to operate under the auspices of a licensed broker. Professional reasoning. Professionals in Delaware should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. When faced with inquiries stemming from potentially irregular information sources, the first step is to verify the legitimacy of the information and the inquiry. Subsequently, the professional should clearly communicate the proper procedures for engaging in real estate transactions, emphasizing the role of licensed professionals in brokerages. Transparency, honesty, and a commitment to following Delaware's real estate license law are paramount in building trust and avoiding legal and ethical pitfalls. Question 9. Regulatory review indicates a Delaware real estate salesperson is advising a client on a potential investment in a new, speculative mixed-use development project. The developer has provided optimistic projections for rental income and future appreciation. The salesperson has reviewed these projections, but has not independently verified all underlying assumptions. Which approach best aligns with the salesperson's professional obligations and Delaware real estate regulations? Option A. Present the developer's projections to the client, clearly stating that these are projections and that the investment carries significant risk due to its speculative nature, while also providing any independently verifiable market data available. Option B. Advise the client that the investment is a sure thing based on the developer's assurances and that the salesperson cannot be held responsible for any potential losses. Option C. Focus solely on the potential for rapid appreciation, as highlighted by the developer, and downplay any associated risks to encourage the client to invest quickly before the opportunity is lost. Option D. Recommend the investment to the client, emphasizing the developer's projected high rate of return and assuring the client that this is a prime opportunity for rapid appreciation. The correct answer is A. Present the developer's projections to the client, clearly stating that these are projections and that the investment carries significant risk due to its speculative nature, while also providing any independently verifiable market data available. Explanation. Scenario analysis. This scenario presents a professional challenge for a Delaware real estate salesperson, because it requires balancing the client's immediate desire for a high return with the salesperson's fiduciary duty to provide accurate and comprehensive investment analysis. The salesperson must avoid making unsubstantiated claims or recommendations that could lead to financial harm for the client, especially when dealing with a speculative investment. The salesperson's role is to facilitate informed decision-making, not to guarantee outcomes. Correct approach analysis. The best professional approach involves presenting a balanced and objective analysis of the potential investment, clearly outlining both the potential benefits and the inherent risks. This includes providing data-driven insights into market trends, comparable properties, and projected cash flows, while also emphasizing the speculative nature of the development and the possibility of losses. This approach aligns with Delaware's real estate licensing laws, which mandate honesty, integrity, and the duty to disclose all material facts. It also adheres to ethical standards that require agents to represent their clients' best interests by providing them with the information necessary to make sound decisions, rather than pushing a particular outcome. Incorrect approach is analysis. Recommending the investment solely based on the developer's optimistic projections without independent verification or risk disclosure is professionally unacceptable. This fails to uphold the salesperson's duty of care and could be construed as misrepresentation or negligence under Delaware real estate regulations. Promising a specific rate of return, even if presented as a possibility, is also problematic. Real estate investments are subject to market fluctuations and unforeseen circumstances, making guaranteed returns unrealistic and potentially misleading. Focusing exclusively on the potential for rapid appreciation, without acknowledging the significant risks associated with a new, unproven development, violates the principle of providing a complete and accurate picture to the client. Professional reasoning. Professionals should approach investment analysis by first understanding the client's financial goals, risk tolerance, and investment horizon. They must then conduct thorough due diligence, gathering all relevant data, and performing objective analysis. This analysis should be presented to the client in a clear, understandable manner, highlighting both potential upside and downside scenarios. The salesperson's role is to educate and advise, empowering the client to make an informed decision, rather than to persuade or guarantee outcomes. Transparency and a commitment to the client's best interests, grounded in regulatory compliance, are paramount. Question 10. Consider a scenario where a buyer in Delaware is purchasing a home for $300,000. The buyer is obtaining a mortgage for 80% of the purchase price, with a loan origination fee of 1% of the loan amount and an appraisal fee of $500. The Delaware transfer tax is 2% of the purchase price, split equally between buyer and seller. The title insurance premium is $1,500. Buyer's attorney charges a flat fee of $750. If the buyer's earnest money deposit was $10,000, what is the total amount the buyer will need to bring to closing, excluding the down payment and prepaid items like property taxes and homeowner's insurance? Option A, $57,000. Option B, $50,000. Option C, $57,750. Option D, $56,250. The correct answer is C, $57,750. Explanation. Scenario analysis. This scenario presents a common challenge in real estate transactions where a salesperson must accurately calculate and communicate closing costs to a buyer. The professional challenge lies in ensuring the buyer receives precise financial information to make an informed decision, preventing potential disputes or misunderstandings. Miscalculations can lead to financial hardship for the buyer or the seller and damage the salesperson's reputation and the brokerage integrity. Adherence to Delaware's real estate licensing laws and ethical standards is paramount. Correct approach analysis. The best professional practice involves meticulously calculating each cost item based on its defined rate or fee, and then summing them to arrive at the total. This approach ensures accuracy by breaking down the complex calculation into manageable steps, allowing for verification of each component. Delaware's real estate regulations emphasize transparency and accuracy in financial disclosures to consumers. This method directly aligns with the ethical obligation to provide truthful and complete information, as mandated by the Delaware Real Estate Commission. Incorrect approaches analysis. One incorrect approach involves estimating the total closing costs by applying a general percentage to the purchase price without itemizing. This is professionally unacceptable because it lacks the precision required by Delaware law for financial disclosures. Such estimations can be significantly inaccurate, leading to the buyer being unprepared for the actual expenses. Another incorrect approach is to only include the most obvious costs like the down payment and mortgage principal, omitting other mandatory fees and taxes. This failure to disclose all relevant costs is a direct violation of the duty of full disclosure owed to the buyer under Delaware real estate principles and regulations. It misleads the buyer about the true financial commitment involved in the transaction. A further incorrect approach is to rely solely on the lender's preliminary estimate without independent verification or calculation of all potential seller-paid and buyer-paid closing costs. While lender estimates are helpful, they may not encompass all fees, such as title insurance premiums, recording fees, or specific local taxes that the salesperson is responsible for calculating or confirming. This reliance on a single, potentially incomplete source can lead to significant omissions and misrepresentations. Professional reasoning. Professionals should adopt a systematic, itemized approach to calculating closing costs. This involves understanding all potential fees, e.g., loan origination fees, appraisal fees, title insurance, escrow fees, recording fees, transfer taxes, homeowner's insurance, property taxes, prepaid interest, and any agreed-upon seller concessions. Each fee should be calculated using the correct rate or fixed amount. This methodical process, coupled with a thorough review of the purchase agreement and consultation with relevant parties, G. Lender title company ensures accuracy and compliance with Delaware's disclosure requirements. Question 11. Upon reviewing a mortgage loan application from a client in Delaware, a loan originator discovers that the client has recently experienced a significant reduction in income due to a temporary layoff. The client is optimistic about returning to their previous employment within a few months and asks the originator to proceed with the application, emphasizing their strong credit history and the potential for a quick approval if the income reduction is not heavily scrutinized. What is the most appropriate course of action for the loan originator? Option A. Proceed with the loan approval process based on the client's verbal assurance that their income will return to previous levels within a few months. Option B. Submit the loan application with the client's current income figures, assuming the income reduction is temporary and will be resolved before final approval. Option C. Advise the client to omit the recent income reduction from the application and focus solely on their past employment history and credit score. Option D. Gather all available documentation, including proof of the recent income reduction and any evidence of impending reemployment, and submit the complete package to the underwriting department for their independent assessment. Correct answer is D. Gather all available documentation, including proof of the recent income reduction and any evidence of impending reemployment, and submit the complete package to the underwriting department for their independent assessment. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a salesperson to navigate the delicate balance between client enthusiasm and the stringent regulatory requirements of the Delaware loan underwriting and approval process. Misinterpreting or circumventing these requirements can lead to significant legal and ethical repercussions for both the salesperson and the lending institution, potentially jeopardizing the client's financial future and the salesperson's license. The pressure to close a deal must be tempered by a thorough understanding of the underwriting standards and the need for accurate, complete documentation. Correct approach analysis. The best professional approach involves meticulously gathering all required documentation from the borrower, verifying its accuracy and completeness, and then submitting it to the underwriting department for their independent review and decision. This approach aligns directly with Delaware's regulatory framework for loan origination, which emphasizes due diligence, accurate representation of borrower information, and adherence to established underwriting guidelines. By ensuring all necessary information is provided to the underwriter, the salesperson facilitates a fair and compliant evaluation of the loan application, upholding ethical standards and protecting all parties involved. Incorrect approaches analysis. Submitting an incomplete loan application with the expectation that the underwriter will fill in the blanks or make assumptions is a direct violation of Delaware's regulatory requirements for loan processing. This practice bypasses the essential due diligence expected of a loan originator and places an undue burden on the underwriting team, potentially leading to flawed decisions based on incomplete data. It also misrepresents the borrower's financial standing, encouraging the borrower to omit or downplay negative financial information, such as a recent job loss or significant debt, constitutes a serious ethical and regulatory breach. Delaware law mandates truthful and accurate representation of all material facts in a loan application. Such actions are considered deceptive and can lead to severe penalties, including license revocation and legal action. Proceeding with the loan approval process based solely on the borrower's verbal assurances without obtaining supporting documentation is equally unacceptable. The underwriting process is designed to mitigate risk through verifiable evidence. Relying on verbal assurances alone bypasses critical risk assessment protocols and exposes the lender to significant financial exposure, violating prudent lending practices and regulatory oversight. Professional reasoning. Professionals in the Delaware loan origination field should adopt a systematic and compliant approach. This involves understanding the specific documentation requirements for each loan product, proactively communicating these needs to the borrower, and diligently verifying the information provided. When faced with incomplete or potentially misleading information, the professional's duty is to seek clarification and additional documentation, not to bypass or alter the process. Maintaining open and honest communication with both the borrower and the underwriting department, while strictly adhering to all applicable Delaware regulations, is paramount to ethical and successful loan origination. Question 12. When evaluating the financial management practices of a real estate brokerage operating in Delaware, which of the following approaches best ensures compliance with the Delaware Real Estate Commission's regulations and supports effective stakeholder communication? Option A. Focusing primarily on generating client-facing financial summaries and only maintaining transaction records that meet the minimum retention periods mandated by Delaware law. Option B. Implementing a comprehensive system for detailed transaction record keeping, proactive budgeting, and timely, accurate financial reporting that aligns with Delaware's specific regulatory requirements and ethical standards. Option C. Prioritizing the creation of internal financial reports for management decision-making, with less emphasis on detailed transaction logs or client-specific financial disclosures beyond what is legally required. Option D. Adopting an ad hoc approach to record keeping and reporting, addressing financial matters only when prompted by client inquiries or regulatory audits. The correct answer is B. Implementing a comprehensive system for detailed transaction record keeping, proactive budgeting, and timely, accurate financial reporting that aligns with Delaware's specific regulatory requirements and ethical standards. Explanation: when evaluating financial management practices for a real estate brokerage in Delaware, a key challenge arises from balancing the need for accurate record keeping and timely reporting with the diverse information requirements of various stakeholders. These stakeholders, including clients, regulatory bodies like the Delaware Real Estate Commission, and internal management, all have distinct needs and expectations regarding financial transparency and compliance. Mismanagement in this area can lead to regulatory penalties, loss of client trust, and operational inefficiencies. The most effective approach involves establishing a robust, systematic process for budgeting, reporting, and record keeping that prioritizes compliance with Delaware's specific regulations and ethical standards. This includes maintaining detailed transaction records, promptly preparing accurate financial statements, and ensuring all activities align with the Delaware Real Estate Commission's guidelines on trust accounts and financial disclosures. Such a comprehensive system not only meets regulatory obligations, but also provides clear insights for internal decision-making and builds confidence with clients by demonstrating professionalism and accountability. An approach that focuses solely on meeting the minimum reporting requirements without a proactive budgeting strategy or detailed record keeping for internal analysis is insufficient. This can lead to missed opportunities for financial optimization and a lack of preparedness for audits or unexpected financial events. Furthermore, neglecting to maintain comprehensive records beyond what is strictly mandated by the Delaware Real Estate Commission can hinder effective dispute resolution and internal performance evaluation. Another less effective approach is to prioritize client-facing reports over internal financial management. While client satisfaction is crucial, a brokerage must also maintain rigorous internal financial controls and accurate record keeping to ensure its own financial health and compliance with Delaware law. Overlooking internal budgeting and detailed transaction logs in favor of superficial client updates can create significant blind spots and increase the risk of noncompliance. Finally, an approach that relies on ad hoc record keeping and reactive reporting, only addressing financial matters when a specific request or issue arises, is professionally unsound. This method is highly susceptible to errors, omissions, and delays, directly contravening the Delaware Real Estate Commission's expectations for diligent financial stewardship and potentially violating record-keeping mandates. Professionals should adopt a proactive and systematic decision-making process. This involves understanding the specific financial management requirements outlined by the Delaware Real Estate Commission, identifying the information needs of all relevant stakeholders, and implementing standardized procedures for budgeting, recording transactions, and generating reports. Regular review and adaptation of these processes are essential to maintain compliance and support the brokerage long-term financial health. Question 13. The analysis reveals that a licensed Delaware real estate salesperson is preparing to list a property. To ensure a legally sound and ethically conducted transaction, what is the most accurate and comprehensive understanding of real estate as it pertains to their professional duties in Delaware? Option A. The market value of the property, as this is the primary concern for any real estate transaction. Option B. Land and all permanent improvements and fixtures attached to it, including buildings, structures, and items permanently affixed for the use and enjoyment of the property. Option C. The land along with any personal property that the seller wishes to include in the sale, regardless of its attachment to the land. Option D. Only the land itself, excluding any structures or improvements built upon it. The correct answer is B. Land and all permanent improvements and fixtures attached to it, including buildings, structures, and items permanently affixed for the use and enjoyment of the property. Explanation. The analysis reveals a scenario where a licensed Delaware salesperson must understand the fundamental definition and importance of real estate to effectively serve clients and comply with state regulations. This requires distinguishing between personal property and real property, a core concept for all real estate transactions. The scenario is professionally challenging because misinterpreting what constitutes real estate can lead to significant legal disputes, financial losses for clients, and disciplinary action against the salesperson. A clear understanding is crucial for accurate property descriptions, proper contract drafting, and advising clients on what is included or excluded in a sale. The best professional approach involves accurately identifying and defining real estate according to Delaware law, which includes land and anything permanently attached to it, such as buildings and fixtures. This understanding is paramount for all aspects of a real estate transaction, from listing agreements to closing. It ensures that all parties are clear on what is being bought or sold, preventing disputes and upholding professional integrity. This aligns with the Delaware Real Estate Commission's mandate to ensure licensees possess the knowledge necessary to conduct business ethically and competently, protecting the public. An incorrect approach would be to consider only the land itself as real estate, overlooking permanent structures and fixtures. This failure to recognize the full scope of real property as defined by Delaware law can lead to misunderstandings about what is included in a sale, potentially resulting in disputes over items like built-in appliances or landscaping, and violating the salesperson's duty to accurately represent the property. Another incorrect approach would be to include items that are clearly personal property, such as furniture or portable appliances, within the definition of real estate for a transaction. This demonstrates a fundamental misunderstanding of the distinction between real and personal property, which is a critical element of real estate law in Delaware. Such an error could lead to misrepresentation and contractual issues, exposing both the client and the salesperson to legal liabilities. Finally, an approach that focuses solely on the market value of a property without a clear understanding of its legal definition as real estate is insufficient. While market value is important, it does not negate the necessity of correctly identifying the subject matter of the transaction itself. A salesperson must first understand what constitutes real estate before they can accurately assess its value or facilitate its transfer. Professionals should approach this by consistently referencing the Delaware Real Estate License Act and related regulations to solidify their understanding of real estate definitions. They should also engage in continuous professional development to stay abreast of any nuances or changes in legal interpretations. When in doubt, consulting with a supervising broker or legal counsel is a prudent step to ensure compliance and protect client interests. Question 14. Governance review demonstrates that a Delaware real estate salesperson is assisting a buyer with a property purchase. The buyer is eager to secure favorable financing terms and asks the salesperson for advice on which lender to use and what interest rate they can expect. What is the most appropriate course of action for the salesperson to take regarding the buyer's financing inquiries? Option A. Assure the buyer that a specific lender the salesperson knows will definitely approve their loan at a competitive interest rate based on the salesperson's experience. Option B. Advise the buyer to forego obtaining formal pre-approval from any lender to maintain maximum flexibility in exploring various financing possibilities. Option C. Clearly explain that the salesperson is not a mortgage broker and advise the buyer to consult with a qualified mortgage lender to discuss their financing options and obtain pre-approval. Option D. Offer to personally contact the lender on the buyer's behalf to expedite the loan approval process and secure the best possible terms. The correct answer is C. Clearly explain that the salesperson is not a mortgage broker and advise the buyer to consult with a qualified mortgage lender to discuss their financing options and obtain pre-approval. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a salesperson to navigate the complexities of financing options while adhering to Delaware's specific real estate licensing laws and ethical obligations. Misrepresenting financing terms or failing to disclose material information can lead to significant legal and ethical repercussions, including license suspension or revocation, and financial damages to the client. The salesperson must balance the client's desire for favorable terms with the realities of lender requirements and disclosure mandates. Correct approach analysis. The best professional practice involves clearly explaining to the buyer that the salesperson is not a mortgage broker and cannot guarantee loan approval or specific interest rates. The salesperson should advise the buyer to consult with a qualified mortgage lender to understand their options and pre-approval status. This approach aligns with Delaware's real estate licensing regulation, which prohibit unlicensed individuals from engaging in activities that require a mortgage broker license. It also upholds the ethical duty of honesty and transparency, ensuring the buyer receives accurate information and is empowered to make informed decisions by seeking professional financial advice. Incorrect approaches analysis. Advising the buyer that a specific lender will definitely approve their loan at a particular interest rate, even if based on a preliminary conversation, is professionally unacceptable. This constitutes a misrepresentation of facts and an overreach of the salesperson's authority, as they cannot guarantee lender decisions. This violates Delaware's regulations against misrepresentation and potentially the duty to deal honestly and fairly with all parties. Suggesting that the salesperson can expedite the loan approval process by personally contacting the lender and influencing their decision is also professionally unacceptable. This implies an undue influence or insider knowledge that the salesperson likely does not possess and could be construed as a deceptive practice. It misleads the buyer about the standard loan application process and the salesperson's role. Recommending that the buyer avoid obtaining pre-approval from a lender to keep their options wide open is professionally unacceptable and potentially harmful. Pre-approval is a crucial step in understanding a buyer's financial capacity and strengthens their offer. Discouraging this essential step can lead to a buyer pursuing properties they cannot afford, resulting in disappointment and wasted effort, and potentially violating the duty to act in the client's best interest. Professional reasoning. Professionals should always prioritize transparency and accurate information. When dealing with financing, the decision-making process should involve clearly delineating the salesperson's role from that of a mortgage professional. This means advising clients to seek expert financial advice and refraining from making guarantees or representations about loan terms or approvals. Adherence to licensing laws and ethical codes of conduct, which emphasize honesty, fairness, and competence, is paramount. Professionals should maintain a clear understanding of their scope of practice and refer clients to appropriate specialists when necessary. Question 15. Implementation of Delaware's real estate licensing laws requires a salesperson to advise a first-time homebuyer on different mortgage options. Which of the following explanations best fulfills the salesperson's regulatory obligations regarding fixed rate, adjustable rate, and interest-only mortgages? Option A. Highlight interest-only mortgages as a way to maximize purchasing power by deferring principal repayment, without dwelling on the long-term payment implications. Option B. Clearly explain that fixed-rate mortgages offer predictable principal and interest payments. Adjustable-rate mortgages may see payment changes based on market conditions after an initial period, and interest-only mortgages mean initial payments do not reduce the loan principal, leading to higher future payments. Option C. Recommend the mortgage type that offers the highest commission for the salesperson, as this is standard practice in the industry. Option D. Emphasize the lower initial monthly payments often associated with adjustable-rate mortgages, as this is typically the most attractive feature for new buyers. The correct answer is B. Clearly explain that fixed-rate mortgages offer predictable principal and interest payments. Adjustable-rate mortgages may see payment changes based on market conditions after an initial period, and interest-only mortgages mean initial payments do not reduce the loan principal, leading to higher future payments. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a salesperson to accurately explain complex mortgage products to a client with limited financial literacy. Misrepresenting or failing to adequately explain the risks and benefits of different mortgage types can lead to significant financial harm for the client and regulatory repercussions for the salesperson and their brokerage. Delaware law mandates that real estate professionals act in the best interest of their clients and provide accurate, understandable information. Correct approach analysis. The best approach involves clearly differentiating between fixed rate, adjustable rate, and interest-only mortgages, focusing on how each impacts monthly payments and the total cost of the loan over time. For a fixed-rate mortgage, the explanation should highlight the stability of principal and interest payments. For an adjustable-rate mortgage ARM, the explanation must emphasize the potential for payment fluctuations based on market interest rates and the initial teaser rate period. For an interest-only mortgage, the critical point to convey is that initial payments do not reduce the principal balance, leading to higher future payments or a balloon payment. This approach directly addresses the client's need for understanding the core mechanics and implications of each loan type, aligning with Delaware's requirement for clear and honest representation of loan terms. Incorrect approaches analysis. One incorrect approach involves focusing solely on the initial lower monthly payment of an adjustable-rate mortgage without adequately explaining the risk of future payment increases. This misleads the client by presenting only a partial picture of the loan's cost and risk, violating the duty of full disclosure and potentially leading to a client being unable to afford their payments later. Another incorrect approach is to present interest-only mortgages as a universally beneficial option for reducing immediate costs, without thoroughly explaining that the principal balance remains unchanged and that future payments will be significantly higher or a large balloon payment will be due. This omission of crucial risk information is a failure of due diligence and ethical practice. A further incorrect approach is to recommend a specific mortgage type based on the salesperson's commission structure rather than the client's financial situation and stated goals. This prioritizes the salesperson's self-interest over the client's best interest, a direct violation of fiduciary duties and Delaware real estate regulations. Professional reasoning. Professionals should always prioritize client education and understanding. When discussing complex financial products like mortgages, the decision-making process should involve 1. Assessing the client's financial literacy and needs. 2. Clearly and accurately explaining the fundamental characteristics, risks, and benefits of each available option. 3. Ensuring the client comprehends the information. And 4. Guiding the client towards a decision that aligns with their financial well-being, not personal gain. Question 16. To address the challenge of accurately representing property rights to a client in Delaware, a real estate salesperson discovers an existing easement documented in the property's title report that affects the property's access. The client expresses concern about how this easement might impact their intended use of the property. Which of the following actions best adheres to Delaware's regulatory framework for real estate licensees? Option A. Inform the client that an easement exists as per the title report and strongly advise them to consult with a qualified real estate attorney to understand its full legal implications and enforceability. Option B. Assure the client that the easement is likely not a significant issue and proceed with the transaction, as easements often do not cause practical problems for homeowners. Option C. Offer to draft a simple addendum to the purchase agreement that redefines the easement scope to better suit the client's needs. Option D. Advise the client to disregard the easement, as it has not caused any issues for the current owner and therefore is unlikely to affect future ownership. The correct answer is A. Inform the client that an easement exists as per the title report and strongly advise them to consult with a qualified real estate attorney to understand its full legal implications and enforceability. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a real estate salesperson in Delaware to navigate the complexities of property rights, specifically concerning easements, without overstepping their licensing authority or providing unauthorized legal advice. Misunderstanding or misrepresenting easement rights can lead to significant legal disputes, financial losses for clients, and disciplinary action against the salesperson. Careful judgment is required to identify the scope of their role versus the need for professional legal counsel. Correct approach analysis. The best professional practice involves accurately identifying the existence of an easement as disclosed in property records, and then advising the client to seek independent legal counsel to understand the full implications and enforceability of that easement. This approach is correct because Delaware real estate law, like most jurisdictions, restricts the practice of law to licensed attorneys. A salesperson's role is to facilitate transactions and disclose no material facts, not to interpret legal documents or provide legal opinions. By recommending legal counsel, the salesperson fulfills their disclosure obligation while respecting the boundaries of their license and protecting the client from potential harm. This aligns with the ethical duty of care and the regulatory framework governing real estate licensees in Delaware, which emphasizes honesty, integrity, and avoiding the unauthorized practice of law. Incorrect approaches analysis, advising the client that the easement is definitely not a problem, and proceeding with the sale without further investigation or consultation with legal professionals is professionally unacceptable. This constitutes providing a legal opinion and making a definitive statement about the legal effect of an easement, which falls outside the scope of a real estate salesperson's license in Delaware. It is a direct violation of regulations prohibiting the unauthorized practice of law and demonstrates a failure to exercise due diligence, potentially exposing both the client and the salesperson to significant legal and financial risks. Suggesting that the client can simply ignore the easement because it hasn't been an issue in the past is also professionally unacceptable. This approach disregards the legal nature of easements, which are binding property rights that can be enforced. It also demonstrates a lack of understanding of property law and a failure to uphold the duty to disclose material facts. The fact that it hasn't been an issue previously does not negate its legal existence or potential future impact. Offering to draft a new agreement to clarify the easement's terms is also professionally unacceptable. This action directly involves the practice of law, as drafting legal documents and interpreting their meaning requires legal expertise. A real estate salesperson is not qualified or licensed to perform such services in Delaware. This action would be a clear violation of regulations against the unauthorized practice of law and would put the client at severe risk due to potentially flawed legal documentation. Professional reasoning. Professionals in Delaware should adopt a decision-making framework that prioritizes client protection and regulatory compliance. This involves a clear understanding of the scope of their license and responsibilities. When faced with situations involving legal interpretations, such as the implications of an easement, the professional's primary duty is to identify the issue, disclose all relevant information from official records, and then strongly recommend that the client engage qualified legal counsel for advice. This ensures that the client receives accurate legal guidance and that the professional operates within the bounds of their licensing authority, thereby mitigating risks for all parties involved. Question 17. Examination of the data shows a unique, older single-family home in a well-established Delaware neighborhood. The property has distinctive architectural features and a large, mature garden, but it does not generate any rental income, and there are no recently constructed comparable properties in the immediate vicinity. Which property valuation method would a Delaware-licensed real estate salesperson most appropriately utilize to advise the seller on a listing price? Option A, income approach. Option B, cost approach. Option C, a combination of all three approaches without specific justification for each. Option D, comparative market analysis. Correct answer is D. Comparative market analysis. Explanation. This scenario presents a professional challenge for a Delaware-licensed real estate salesperson because it requires them to select the most appropriate property valuation method for a unique property, balancing the needs of their client with the ethical and regulatory obligations of their license. The salesperson must demonstrate a nuanced understanding of how different valuation methods apply to various property types and market conditions, ensuring the advice provided is both accurate and compliant with Delaware real estate regulations. The most appropriate approach in this situation is the comparative market analysis. This method is best suited for unique properties because it relies on identifying and analyzing recent sales of similar properties in the immediate vicinity. For property with distinct features that may not generate consistent rental income or have readily available cost data for new construction, direct comparison with the most similar sold properties offers the most reliable indication of market value. Delaware real estate regulations, while not dictating specific valuation methodologies, emphasize the salesperson's duty to provide competent and diligent service, which includes using valuation methods that are appropriate for the specific property and market. Ethically, this approach prioritizes providing the client with a valuation grounded in observable market activity, which is generally the most persuasive and understandable for sellers. Using the income approach would be inappropriate and potentially misleading for this unique property. While the income approach is valuable for income-generating properties like apartment buildings or commercial spaces, it is less reliable for a single-family residence with unusual characteristics. The accuracy of this method depends heavily on projecting future rental income and applying appropriate capitalization rates, which can be speculative and difficult to determine for a property that doesn't have a clear rental history or comparable rental data. This could lead to an inaccurate valuation and potentially violate the duty of competence if the salesperson cannot reliably apply this method to the specific property. The cost approach, which estimates the cost to replace the property, is also not the best fit here. This method is most effective for newer construction or special-purpose properties where replacement cost is a primary driver of value. For an older, unique home, estimating depreciation accurately can be highly subjective, and the cost of rebuilding a unique architectural style might not reflect what a buyer is willing to pay in the current market. Relying solely on this method could result in a valuation that is disconnected from market realities, potentially failing to meet the standard of care expected of a Delaware licensee. Professionals should approach property valuation by first understanding the property's type, its intended use, and the available market data. They should then select the valuation method that are most likely to produce an accurate and defensible estimate of market value for that specific property. This involves considering the strengths and weaknesses of each approach in the context of the property and its market. If multiple approaches are used, the salesperson should be able to reconcile the results and explain the rationale for the final estimated value. This systematic approach ensures compliance with professional standards and ethical obligations to clients. Question 18. Research into the diverse landscape of government-backed mortgage programs in Delaware reveals that buyers often inquire about FHA, VA, and USDA loans. When advising a client who is a first-time homebuyer with a moderate credit score and limited savings, and who is looking at properties in a suburban area outside of Wilmington, which of the following represents the most responsible and informative course of action for a Delaware licensed real estate salesperson? Option A. Inform the client that VA loans are the most advantageous government-backed option available to all buyers, regardless of military service, due to their favorable terms, and focus the property search accordingly. Option B. Suggest that USDA loans are universally applicable for suburban properties and would likely provide the most beneficial financing for their situation, encouraging them to seek lenders familiar with USDA programs. Option C. Advise the client that FHA loans are generally the best option for first-time homebuyers with moderate credit and limited savings, and proceed with marketing properties that meet FHA financing requirements. Option D. Explain the general benefits of FHA, VA, and USDA loans. Discuss how each program's eligibility and purpose might align with the client's situation and property search, and strongly recommend they consult with multiple mortgage lenders, specializing in these loan types for personalized guidance and pre-approval. The correct answer is D. Explain the general benefits of FHA, VA, and USDA loans. Discuss how each program's eligibility and purpose might align with the client's situation and property search, and strongly recommend they consult with multiple mortgage lenders, specializing in these loan types for personalized guidance and pre-approval. Explanation. This scenario presents a professional challenge because real estate licensees must navigate complex government-backed loan programs while ensuring they provide accurate and ethical guidance to clients. Misunderstanding or misrepresenting the nuances of FHA, VA, or USDA loans can lead to significant financial harm for buyers and potential legal repercussions for the licensee. Diligence and a thorough understanding of program requirements are paramount. The best approach involves a comprehensive understanding of the specific eligibility criteria, benefits, and limitations of each government-backed loan program. This includes recognizing that FHA loans are designed for borrowers with lower credit scores and smaller down payments. VA loans offer significant benefits to eligible veterans and active-duty military personnel, and USDA loans are intended to promote homeownership in eligible rural and suburban areas. A licensee should be prepared to explain these distinctions clearly, advise clients on which programs they might qualify for based on their individual financial situations and property location, and recommend consulting with a qualified mortgage lender for definitive pre-approval and program-specific details. This aligns with the Delaware Real Estate Commission's emphasis on licensee competence and ethical conduct, requiring agents to possess sufficient knowledge to advise clients accurately. An incorrect approach would be to broadly recommend a government-backed loan without understanding the client's specific circumstances or the property's location. This fails to acknowledge that FHA, VA, and USDA loans have distinct target demographics and geographic restrictions. For instance, recommending a USDA loan for a property in a major metropolitan area would be inappropriate and misleading. Another incorrect approach is to overpromise benefits or guarantee loan approval, which is outside the scope of a real estate licensee's authority and can lead to client disappointment and ethical violations. Licensees are not mortgage lenders and should not provide definitive loan advice or guarantees. Furthermore, suggesting that any government-backed loan is universally superior to conventional financing without considering the client's financial profile and goals is also a flawed strategy. Each loan type has its own set of advantages and disadvantages that must be weighed against the borrower's unique situation. Professionals should employ a decision-making process that prioritizes client education and accurate information. This involves staying current with the regulations and guidelines of government-backed loan programs, understanding the client's financial profile and property preferences, and clearly communicating the role of the real estate licensee versus that of a mortgage lender. When in doubt about specific loan program details, licensees should err on the side of caution and direct clients to qualified mortgage professionals for expert advice. Question 19. Which approach would be most appropriate for a licensed real estate salesperson in Delaware when establishing commission structures and fee arrangements with clients to ensure full compliance with state regulations and ethical standards? Option A. Agreeing to a commission that is contingent on the sale price exceeding an undisclosed target without explicit written consent from the seller. Option B. Accepting referral fees from third-party service providers without informing the client of these additional financial benefits. Option C. Informing the seller of the total commission amount, but withholding details about how it will be split with other brokers or agents. Option D. Fully disclosing all commission splits and fee arrangements to both buyers and sellers in writing at the outset of representation, and reiterating these details in all relevant agreements. Correct answer is D. Fully disclosing all commission splits and fee arrangements to both buyers and sellers in writing at the outset of representation, and reiterating these details in all relevant agreements. Explanation. This scenario is professionally challenging because it requires a real estate salesperson in Delaware to navigate commission structures and fee arrangements in a way that is both legally compliant and ethically sound, particularly when dealing with potential conflicts of interest or misrepresentations. The core of the challenge lies in ensuring transparency and fairness to all parties involved, adhering strictly to Delaware's real estate licensing laws and regulations concerning compensation. The best approach involves clearly disclosing all commission splits and fee arrangements to both the buyer and seller at the earliest possible stage, ideally in the listing agreement and buyer representation agreement, and then reiterating this information in the purchase agreement. This approach is correct because Delaware law, like most jurisdictions, mandates full disclosure of all material facts, including compensation. Transparency in commission structures prevents misunderstandings, avoids potential disputes, and upholds the fiduciary duty owed to clients. It ensures that clients are fully informed about who is being compensated and how, allowing them to make informed decisions. This aligns with the ethical principles of honesty and integrity expected of licensed real estate professionals, an approach that involves only disclosing the total commission to the seller and not detailing how it will be split with a cooperating brokerage or the salesperson's own broker is incorrect. This failure to disclose the full details of the fee arrangement to all parties, especially the seller who is directly paying the commission, can be considered a misrepresentation or omission of a material fact under Delaware real estate regulations. It prevents the seller from having a complete understanding of how their funds are being allocated. Another incorrect approach would be to agree to a commission structure that is contingent on the final sale price exceeding a certain undisclosed threshold, without clearly documenting this arrangement and obtaining explicit written consent from the seller. This creates a secret incentive for the salesperson that could potentially lead to steering the client towards a sale that might not be in their best interest, solely to meet the undisclosed contingency. This violates the duty of loyalty and good faith owed to the client, and is likely a violation of Delaware's rules regarding compensation and conflicts of interest. Finally, an approach where a salesperson accepts a referral fee from a third-party service provider, e.g., mortgage broker or home inspector, without the informed written consent of their client, is also professionally unacceptable. While not directly a commission structure between buyer and seller, it represents a hidden financial benefit to the salesperson that could influence their recommendation of services. Delaware regulations require disclosure of any potential conflicts of interest or financial benefits derived from recommending ancillary services to clients. A professional decision-making process for similar situations should involve a commitment to proactive and comprehensive disclosure. Before entering into any agreement, a salesperson should thoroughly review their commission structure and fee arrangements, ensuring they are clearly defined, legally compliant with Delaware law, and ethically sound. They should then communicate these details openly and honestly with all parties involved, documenting all agreements in writing. When in doubt, seeking clarification from their broker or consulting Delaware's real estate licensing regulations is paramount. Question 20. Operational review demonstrates that a Delaware real estate salesperson has listed a property under an exclusive right to sell agreement. The total commission agreed upon is 6% of the sale price. The listing agreement also stipulates that the listing broker will share 50% of the total commission with the buyer's broker. If the property sells for $400,000 and the buyer was procured by a cooperating broker, what is the amount of commission the listing broker will receive? Option A, $12,000. Option B, $16,000. Option C, $18,000. Option D, $24,000. The correct answer is A, $12,000. Explanation. Operational review demonstrates that accurately calculating commission splits based on different listing agreement types is a fundamental skill for Delaware real estate salespersons. This scenario is professionally challenging because it requires not only a clear understanding of the terms of each listing agreement, but also the ability to apply those terms mathematically to determine the correct compensation for each party involved. Miscalculations can lead to disputes with clients, cooperating brokers, and potentially disciplinary action from the Delaware Real Estate Commission. The best professional practice involves meticulously adhering to the terms of the exclusive right to sell agreement. In this agreement, the seller's agent is entitled to a commission regardless of who procures the buyer. The total commission is 6%, and the listing broker agrees to share 3% with the buyer's broker. Therefore, the listing broker receives $0.06 times $400, 0,000, 03 times $400, 000 equals $24, 000 $12, 000 equals $12, 000 and the buyer's broker receives $0, 03 times $400, 000 equals $12, 000 This approach is correct because it directly reflects the contractual obligations established in the exclusive right to sell agreement, ensuring fair compensation based on the agreed-upon terms and the successful sale of the property, which is a core principle of real estate brokerage ethics and Delaware's regulatory framework for commission agreements. An incorrect approach would be to assume that under an exclusive agency agreement, the listing broker only earns a commission if they find the buyer, and if the seller finds the buyer, no commission is due. This is a misinterpretation of an exclusive agency agreement. While the seller does reserve the right to find the buyer themselves without owing a commission, in this scenario, the buyer was procured by a cooperating broker, triggering the commission obligation. Furthermore, even if the seller had found the buyer, the agreement typically still stipulates a commission, albeit potentially at a reduced rate or with specific carve-outs, which is not reflected in this incorrect assumption. Another incorrect approach would be to calculate the commission based on an open listing scenario, where the seller can list with multiple brokers and only the broker who procures the buyer earns a commission. This is fundamentally flawed because the scenario explicitly states the property was listed under an exclusive right to sell agreement, not an open listing. Applying the rules of an open listing to an exclusive right to sell agreement violates the contractual terms and misrepresents the agreed-upon compensation structure. A further incorrect approach would be to divide the total commission equally between the listing broker and the buyer's broker, regardless of the specific commission split outlined in the listing agreement. This ignores the agreed-upon percentage split of 3% for the buyer's broker, which is a critical component of the compensation structure in an exclusive right to sell agreement. Such an approach fails to honor the contractual agreement and can lead to underpayment of the buyer's broker, creating ethical and legal issues. The professional decision-making process for similar situations should begin with a thorough review of the executed listing agreement to understand its specific terms and conditions, particularly regarding commission rates and splits. Next, identify the type of listing agreement in place: exclusive right to sell, exclusive agency, or open listing, as this dictates the commission obligations. Then, apply the agreed-upon commission percentages and splits to the final sale price, performing the necessary calculations. Finally, ensure transparency and clear communication with all parties involved regarding the commission distribution.